The market is starting to look a lot more red, as we can see from yesterday's performance. And if we zoom out to the last 5 days, so just in the last week, we're seeing not only patches of red, but also companies that are now down. We're talking double digit, and that is what we want to cover in the episode today. Companies that have released their earnings this week and are down significantly. That's going to include CMG, which is down 15% on the week. We're going to look at some of the semiconductors as well. Texas Instruments down 15%. Intel, whilst it just says -1, they've reported and they're also down very, very significantly. And that will also include Centene Corporation, which is down, in fact, more than double digit today after already being down massively just over the last few weeks, as well as a few others, so make sure you do stay tuned. As we've already said, earnings week will bring volatility. These are some of the names that have reported, and as we said, do expect the upcoming weeks to also throw out a few surprises. Now, if we just look at the S&P, this highlights how companies have performed after they've released the earnings, really backing up what we said. Do not be surprised if the vast majority of companies that are to come who will report will in fact be down. Just something to consider if you really do want to get into companies very quickly. But we would also highlight, whilst analysts, as we note here, believe every company in the S&P is a buy, highlighted on a scale of 1 to 5, those sitting towards a 1, more like a strong buy. Those in the red, it is the opinion of analysts that they are a strong sell. This is just telling you right now, analysts are saying buy, 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 and that is pretty much what investors are doing. Sentiment is sitting right there at extreme greed. But whilst we sound like a broken record, please understand, even incorporating growth into companies' valuations, for the large part, many of these companies looking severely overvalued. They are being stretched and quite significantly. And whilst we included this in yesterday's episode, we just have to reiterate where companies are sitting. The tech sector is sitting in the 95th percentile, AP around 30x, whilst we see others here that are looking incredibly attractive: real estate, financials, healthcare and energy, the ones that so far have been beaten down the most. But as we said, we want to uncover today those that are being battered after their earnings. Is it a case of buying the dip, as we'll get to the valuation of each one? And if you're not interested in every single one, we also have timestamps so you can skip ahead. First one has to be Chipotle Mexican Grill. It has been requested and also down around 14% just yesterday. We'll cover the earnings too, but over the last year, they're pretty much flat. Year to date, they're down 25%. They've had 1/4 of their market cap wiped out just in 2025 alone. And if you're a longer term shareholder, you would be up 208%, so still outperforming the S&P. Worth highlighting, they are now trading around the 52-week low, but we do want to really point out that on a forward valuation, it is still not cheap by any means. Currently valued around 43, 44 on a forward P, with just one buy rating from Wall Street, although that is fairly high, 4.31 out of 5, 4.5 would flip that into a strong buy sentiment. Now we can see from the title, they cut their outlook, which is never great. That will always be punished by the market, and they've also said they've got a traffic slump, which we're going to get into, despite free burritos. Bit of an interesting statement here. They're giving out free products, but still consumers are not coming in, or at least that is what the data is showing. And we can see that they've cut their annual outlook, not for the first time, but for the second time this year. That is an incredibly bad sign. We would straight away say a red flag indicator, and that they expect sales at their restaurants to be pretty much flat for the full year. Always understand, when a company says flat, it doesn't mean it's the same as the last year, because when you incorporate inflation of around 4%, which is the historical average, then in reality it means numbers are decreasing. And we can see once they released their earnings, shares were down around 7%, which is also something we want to highlight. After earnings, you may see a drop, whether that's 1%, 2%, 3%. More often than not, what we have seen is upon market open, share price goes down even further. Something noted from Chipotle, which was down around 14% yesterday. Now, if you like looking at trend analysis, one thing that we have seen is that they are now sitting on that support line from the COVID lows. If you're interested, just something to point out. But ultimately, this is where the company is really starting to falter, and that is why we got a cut for the second time on the outlook. We can see here comparable sales growth year on year from this quarter is down 4%. Not only is it negative, but we can see it has started to decrease from the same quarter last year where it was up double digit 11%, down to 6, then 5, then flat. Now we're seeing -4. We'd also highlight this could be a potential recession indicator, and that is what we need to understand when looking at earnings coming up. Are they all pointing to the same thing? Are we seeing consumers get a bit more anxious and perhaps less spending? And we can also highlight here restaurant sales pretty much peaking over the more recent quarters. Now it's dropped around 3.1%. That's also what we saw with comparable sales, -4. And also for a company, forward valuation very high. We can see here compounded annual growth rate in the mid to high single digit. Again, probably you'd want to see a lot more given that valuation. Now their growth comes in at a B. We're talking 9% year on year, expected around 12 this year, which yes is above the sector, although that is pretty much low single digit, but they're growing slower than they have done over the last 5 years, around 15%. And whilst we again get to see nice EPS projections, 17%, that is above the sector, but quite some way below their historical 25%. So we've got to understand, in reality, are we seeing now a complete slowdown of what was perhaps once a growth company, hence the valuation? But over the next 4 quarters, they are still projecting strong growth to the EPS, double digit for the large part. At a bare minimum, they've either been in line or outperformed. 100% track record, and if you're buying now and they hit their EPS target for next year, then the forward P does come to 32.2. Finally, before we get to our valuation, we can see institutional ownership at 91%. They were selling $6 billion over the last year, buying a lot more. We're talking $20 billion, so clearly very bullish. But in the most recent quarter, we have pretty much seen it consistent in terms of buys and sells. But what we would say, as we can see above, over the last year, institutions, they've been net buyers. Now with each of these companies, we are going to get to our intrinsic value, which for CMG gets to $59. We can see derived from the DCF model. Quickly explain how we got there. We have the average growth, 41% year on year. Most recent, sitting at 23. We've gone for 17.5, which we will explain shortly. But you can note here, low, medium and high, 15, 20, 25. Numbers, as always, are subjective. You can grab a copy of this model by clicking on the pinned comment below, getting to your own numbers, whether it's for CMG or any others. Now, typically, we do take the middle rate of 20%. However, we are starting to see issues with the company. They are starting to slow down. So we've gone a bit more conservative between low and medium. So 17.5 with a discount rate. We get the present value of future free cash flow and terminal price. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, $59. Now we'll also highlight all the other levels as well for full transparency. If you believe 20% to be most appropriate, $70, 56% upside. If you believe 15, $49. And if you're a lot more optimistic, you think this is just a blip, just a one-off, 25%, $99, 120% upside, more than a double. As we've explained, we will be taking 17.5% through to get to our margin of safety, but also worth noting, when using a reverse discounted cash flow model, already baked into the numbers is just under 14% growth moving forwards. If you believe it should be higher, then right now undervalued in your opinion. Vice versa, if you believe it should be lower, then overvaluation. As we alluded to, we like to use an MOS and typically 10% as the starting point. Execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that in the episode, a buy at $53, then we keep going till it's near the current trading price, and ultimately it's sitting somewhere right now between 20 to 25%. Maybe one worth considering if you like the future prospects of the company. Wall Street themselves, whilst lowering their target, still $62 into the next year, gives 38% upside. So let us know, in your opinion, 20 to 25% MOS, CMG, stock number 1 that has been battered buy, hold, or avoid, and we'll also reflect on those that believe perhaps 20% to be more appropriate. You are getting a higher MOS naturally as the growth you're expecting is a lot higher. At 30%, still a buy. At 35 is where we would see it. And likewise, we can do the same thing for those that believe 15%. No surprises, the MOS will be lower, sitting somewhere around the 10% point. Give us your thoughts on CMG. Before we move on, we just want to let you know we have released our latest free weekly article. We drop one every single Monday morning directly to your inbox, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of July. We release one at the beginning of each month, so August copy will be coming soon. Also incorporating Wall Street and their projected price target over the next year. And on top of that, you can grab a copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move on to LVMH, which whilst it's only down around 4% so far, given the earnings, we wouldn't be surprised to see this even lower. It's down 22% over the last year. Year to date, down 16%. Over the last 10 years, interestingly though, you still would have outperformed the S&P, up just under 200%, trading near the 52-week low. Again, wouldn't be surprised to see this touch very soon, and we get one buy rating from Seeking Alpha, whilst highlighting PE on a trailing 12-month below 22. Now, if you want to take a look at the valuation on an EV to EBIT basis, we can see it's pretty much around a decade low, sitting just below 14. And we get the news that investors didn't want to hear, and that in fact is that the luxury sector overall is taking quite a large and significant hit. If we just look at their earnings on a segment by segment basis, fashion and leather goods are down around 9%, wine and spirit down around 4%, watches and jewelry pretty much flat. We do get some growth in the selective retailing like Sephora, as well as a marginal 1% in perfume and cosmetics. And actually, we have some analysts that are a lot more bullish after hearing, given the worries aren't as big as they thought. We have HSBC saying that the higher than expected profit margins was a fairly positive sign, and Deutsche Bank analysts coming out that saying whilst the group earnings wasn't stellar, there were some glimmers of hope. And if you want to take a look at the first half of 24 against 2025, doesn't look that much better. Revenue down 4%, net profit down 22%. Free cash flow is up though, that's nice to see. And interesting to read the commentary from the CEO. If you want to read the whole thing, you can pause. But the bit in yellow is very, very interesting. I think that in a company such as LVMH, there are a number of things that we can be sure about over 50 years. In 50 years time though, will the iPhone still be used? And whilst he questions that, he says, I believe I can say without being mistaken that in 50 years time, we'll still be drinking Dom Perignon. Let me know whether you agree with him. Do you believe iPhones will still be here in 50 years time? Are we going to have the iPhone 70, the 70 Pro, 70 Pro Plus? Or will that be outdated and will we still see bottles of Dom Perignon? One thing though worth highlighting, as we always like to incorporate insider buying because we believe it's a bullish signal, it has really ramped up over the last few years. Although worth mentioning, the majority of this is from the CEO himself, who does hold a very significant portion in the company. And we also want to highlight that their last full year, FY24, wasn't great at all. Their revenue was down 2%. They had deficiencies to their margin, 2 percentage points on the gross and 4 on both operating and bottom line. And that whilst growth was down, it is expected this year to be positive, although marginally at around 2%. Just compare that to their 5-year average at 10%, we can see the luxury sector as a whole has been hit hard. And if we get to our intrinsic value today, it gets to $659, the average of the three. Now we're not going to go through each model, but just because we like to for consistency, we'll let you see here the DCF model. Reverse cash flow is telling us that 3.3% is currently baked into the numbers. Worth noting, because if you solely want to look at this model, you could perhaps consider this to be undervalued and fairly significantly, but intrinsically we do get a margin of safety, 10% about 593, at 20, 527, not quite there yet. After the release of this episode, it could really come down quite significantly, so we'll also let you know at 30%, 461. So currently at 15% is where the company sits. Wall Street themselves, for now, $670 price target into next year, upside of 21%. LVMH, let us know your thoughts, buy, hold or avoid. We then move on to Centene Corporation, which is down 10% in the pre-market, or was at least after the beginning of their results. Now the driver behind this was their quarterly loss, bigger than what the market was expecting. In fact, when they reported a loss of 16 cents, the actual expectations by the market was positive 39. That is a very significant difference, positive to negative on top of that. But they did in fact outperform in terms of the revenue, 49 billion, expectations around 44. And we can see this was initially the main driver for the drop. In fact, we also got to see their medical costs increase. These are all things that investors did not want to note. However, and very surprisingly, not only have they been down a lot, down 9% yesterday, they've now gone from a double-digit drop in the pre-market. They're now sitting positive, so once you watch this episode, perhaps it will be up in the double-digit. Now, over the last year, they're down 60%. Year to date, they're down 56%, losing more than half of their market cap in 2025. Over the last 5 days, they're down. Over the last month, we can see, in fact, and we did release a dedicated episode, July the 1st, they went from $57 to sitting around the $34 mark. Now, they're currently trading pretty much near their 52-week low. Again, when market opens, I'll be very interested to see which way this goes. A significant distance from their 52-week high of $81, and we have a valuation incredibly low. As we spoke at the beginning of the episode, this is one of the industries that does look like very, very cheap, very undervalued. Market has really neglected this and perhaps gone one step too far. We see Seeking Alpha with a buy sitting at 4 out of 5. Wall Street 3.45, not far off the 3.5 to flip this into a buy rating. And you can see here they flip from negative double digit to now sitting positive around 5, where in fact this is due to the CEO's confident tone during the earnings. Now, whether or not it says here genuine recovery or a short squeeze, something we'll find out, but overall looking promising given the commentary. And if you were wondering why exactly we're seeing Centene being hit a lot harder than other companies, well, this is all due to Medicaid, something again we spoke about in detail in our in-depth dive. The majority of Medicaid does come from Centene, where we see 60%. In fact, Molina Health higher at 88%. This is another one we will cover later on today. And if you actually just want to take a look back at the last time we started to see these drops in companies in the healthcare sector, quite a wide variety and in terms of the different mispricings. But if you look at the outcome, what happened ultimately, for example, we have UNH, one that is under significant pressure. They actually saw their EPS growth resumed. Company did a lot of share repurchases, something I would like them to see do now as well, and others as well. For example, if you want to look at Molina not that long ago, where they had ACA losses, we can note here they turned over 1 billion profitable in just the next 5 years. Many different cases. Question is, 1, can you hold through periods where we see share prices really get hammered? And 2, do you believe this is actually an isolated event and that we won't see these positive outcomes? And this just really reflecting the reason why we got the initial 10% drop. It was a surprise adjusted loss, as we highlighted, 16 cents. Their medical ratio also very poor, 93%, expected 89%. But as it says here, there'll be more information on the conference call, which is what we're hearing now, and that is why we are seeing it up around 7%. Now, in terms of the growth, we get to see an A-, revenue year on year, 7%, expected around 5 to 6 this year, which isn't too far off the sector median, but Centene was a company with historical double-digit growth, and EPS not the greatest, projected 4% moving forwards. Now, it does look terrible, but you could always argue we are seeing the market overreact. It's what this is telling us now in terms of the ratings. A+ on valuation, A- on growth, and A- on profitability. And we can see here EPS expected better from both sector and their own 5 years, sitting around the 10 to 11% point. Now, we also expect growth to be negative moving forwards, no surprises there whatsoever. And whilst historically they had a 100% track record in terms of EPS beats, Q2 that was released, unfortunately, as we said, not just a miss, but also negative. If they happen to hit the EPS target for the next full accounting period, forward P will be below 5. That is incredibly low, and unless the company is going to evaporate into space, could be one for consideration. We'll also point out institutions with 94% ownership sold $6.4 billion in the last year, buying pretty much around a similar level, but we see in the most recent quarter a little bit more selling than buying, so overall, by a small distance, they are net sellers. Now, our intrinsic value has stayed the same as we've shown in previous episodes at $73. We've kept the initial price of $24, that was at the double-digit drop rate, but who knows where this company will in fact go, whether it revisits this or continues to go higher. Now, Wall Street themselves project $46 into the next year. That is upside 92%. Whilst they have been lowering it, they still see this as a stock that could in fact double. And as we look at our DCF model, for those that are newer, we'll just explain how we got to this figure. So firstly, we have gone from a very conservative growth rate, that is -4%, a decrease year on year. We've used the initial period for 2025 as the first quarter times by 4, and then we've cut it in half. So again, extremely conservative. And you can see here, low, medium and high, -4, -2 and 0, all indicating at a bare minimum, if they hit either of these, we're talking more than 3 times the upside. Also, fascinating to see on a reverse DCF model incorporated to the growth is a drop of 28% year on year. So you can see, at least from a numerical perspective, this company is severely undervalued, but ultimately there are a lot of risks that you need to be aware of, and that is something we have mentioned before, so check out the previous episodes. If you want to take a look at the actual MOS, as you can see, we are talking about a very significant one today at 70%, not quite there yet. We're talking 65 at $26. Now, if it continues to climb, just so you are aware, at 60%, about 29, at 55, $33, and at 50%, 37. Right now, though, it is sitting around 65% MOS. Give us your thoughts. Centene Corporation, buy, hold, or avoid. We then move on to Texas Instruments, which reported just this week down 6% over the last year. They're pretty much flat year to date. Just in the last 5 days, though, they are down double digit, -15%. Over the last 10 years, still outperforming the S&P, up 272%. Now, currently trading around the midpoint of the 52-week range, we get 1 week buy rating from Wall Street, and we can see, in fact, their profit and their sales were up in the quarter, which is always a great sign, pretty much something you want to see at a very basic level. They reported EPS 141, higher than what analysts were expecting at 136, above the same quarter last year, and their revenue was up double digits, 16% to around $4.5 billion, and analysts were expecting lower, so again, very nice to see. But it does look like the main issue, the reason that we got the drop, was the expectations for the next quarter, expecting around 4.45 to 4.8 billion, with EPS around the 130 to 160 mark. Analysts wanted to see around 151, which in the middle rate does sit at 148, so they weren't too happy. And we can see another reason for the drop is around the tariff fears, where they said the surge in demand that they were getting due to tariffs is going to be short-lived, and therefore that did hit those expectations. Now, on a forward P basis, it sits at 31, which is well above the 5-year average of 25. That in itself is one overvaluation signal. However, you are getting a yield near 3% that sits above the historical 2.7. But importantly, when we take a look at the blue tunnel, which as always indicates the expected fair price, we see disparity between where it sits today and the upper end. That overvaluation is something noted over the last year, and actually does go quite as far back as to 2024. This company, more often than not, in fact, when we look at the last 5 years, is in an overvalued space. Very rarely do you get to see it in severe undervaluation. And their growth is also very disappointing, especially considering the extremely high valuation. We're talking year on year and expected this year, 3 to 4%, barely in line with inflation. Sector does sit higher, but also worth pointing out that historically, this isn't a fast-growing company. EPS, though, sitting around 13% projected, is around the sector of 14, and above their own 5-year 7.3. And we do also like to see green right across the board, expecting forward P to lower 27.4 into the next full year. This for us definitely looks way too high. And institutions with their 85% ownership sold around 15 billion. They bought a little bit more, but we actually get to see a lot more buying in Q2. More often than not then, they do look to be net buyers. Now our intrinsic value comes to $111. Now we'll actually show you how we got there. You might even believe it should be lower, but incorporating a 20% growth rate, we can see 111 indicating downside of 59%. The reverse DCF model really highlighting just for you to believe this to be intrinsically valued today at a reasonable rate. 27% is the growth rate moving forwards. Using 15, 20 or 25 will all come to downside, and therefore there is very little value in us looking at a margin of safety. What the conclusion is, we believe this to be very, very highly valued and definitely not one for consideration. Wall Street, however, see this at 212. They identify 15% projected upside into 2026. Let us know your overall thoughts. You agree, you disagree, but ultimately this company trading for a very high forward P. The growth is very minimal, at least in terms of revenue, and there is no margin of safety. We then move to Molina Health, which was down 17% yesterday, down 34% in the last year, down 46% year to date. Over the last 10 years, underperformed the S&P, up 110%, trading at a 52-week low. We get a fairly rare strong buy from Seeking Alpha, a buy from Wall Street, and a forward P sitting at 8.5. We do, however, see a large earnings miss, but however, we note a revenue beat, something we've seen from a lot of companies in the industry. EPS miss, revenue beat, and they've also lowered their profit forecast, the same issue we've heard from many companies in the sector. Medical costs are in fact increasing, and their growth does get a B, although revenue 16% year on year, 12% projected moving forwards, is above the sector. We're talking in the mid to high single digit, lower than their own historical values, and they only project one of the next 4 quarters to be growth, 50% track record, most recent one a miss. But if they hit their EPS for next year, we're talking a forward PE below 7. And institutions with their 99% ownership sold 3.2 billion, only bought 2.5, but we see a little bit more buying in Q2 than selling. And our intrinsic value of $225 is derived using a growth rate of 4%, pretty much what it has been average over the last 10 years. You can see though 2, 4 or 6 all indicating upside, and the reverse DCF highlighting that a drop of 1.5% year on year is what is incorporated into the numbers today. So you are getting a margin of safety based on the 4% growth rate moving forwards, and as we keep on going, you are getting pretty much bang on 30%. Wall Street themselves, they see this $284 into next year. That is a massive 80% upside. We can also be conservative and take a look at the 2% rate, but this also highlights a margin of safety, although not as significant. 15% a buy at 20%, that is where it sits right now. Molina Health, give us your thoughts. Maybe you like it, maybe you prefer others in the industry, or you may not in fact like the industry whatsoever. And then we get to Intel, which was down 4% yesterday, down around 8% in the pre-market. Over the last year, down 29%. Year to date, they're actually up 13%. Over the last 10 years, down 22%. If you've been holding this for the 10-year period, you would have less than your initial investment, trading when the market opens probably right there near their 52-week low, with every single analyst giving this a hold. Now, earnings weren't great whatsoever. Their top line, in fact, is up barely year on year. Their margins are down 9 percentage points, as well as their EPS down 12 cents. And we also notice their gross margin continuing to decrease. Remember, that opposite is what we want to see. That is ultimately criteria of high quality company. Revenue increasing as well as their gross margin. And we can see from the headline that they did outperform on the revenue. So if we take a quick look at some of the headlines, in terms of the EPS, not great at all. They reported a loss of 10 cents. Revenue, as stated, was a beat, and it's also worth reiterating this company has been doing a lot of layoffs. In fact, their planned layoff of 15% has nearly all been done, and their growth just not looking good. -4 year on year, -1 expected moving forwards, and we can see the industry the complete opposite. They are positive, expected as well, around the mid to high single digit, and EPS just not expected to grow, at least in the shorter term. Although when we take a look December 2026, they are projecting positive 75. That will in turn lower their forward P to 30, but does look very high for the situation and the current climate of the company. And we can see institutions 65% ownership, selling 5 billion, buying twice as much in the same time frame, but buying a lot more in Q2. So actually very bullish, significant net buyers, at least in the last year. And our intrinsic value of $20 is derived using a growth rate of 6%. You can also see that is what the reverse DCF comes to, but if you believe in fact it should be higher, like 8%, 15% upside, 4%, downside of 15%. Right now though, this is based on future free cash flow of sitting around 5 billion. It will be updated once we do get the full year, but right now no MOS. If you want 10%, buy at 18, at 20, 16, and at 25, around 15. Wall Street themselves projecting 13%, $22.50 target. Let us know, Intel, buy, hold, or avoid. The same with the other companies that we have gone through today. And don't forget, as always, to sign up to the free weekly newsletter. Grab those spreadsheets, come and join us in the Patreon where we cover buys and sells. And as always, have a great day. We'll see you all on the next one.